Good morning, friends. Okay, let's discussion on mutual funds chapter. In the last class, we learned basics of mutual fund. We learned that mutual fund is basically an instrument for long-term wealth creation. In that, we learned how do we compare the MF return vis-a-vis the own return of a mutual fund. If a person can get a higher return by own investing, then the MF has to provide. For example, if I'm able to get 14% return, which is a very healthy return by own investing, the MF has to give more than 14 because of two items. One is there is an initial expense ratio, and second there is a recurring expense ratio. So the MF return has to be equal to own return divided by 1 minus initial expense ratio, 1 minus initial expense ratio, plus there is a recurring expense ratio which also needs to be taken care of. So these two parts needs to be taken care of. Also, we learned that sometimes what can happen is if you invest on your own, you need to spend a lot of time tracking the market. So if you're spending time on tracking the market, there is going to be an opportunity cost. That cost will get factored in a cost benefit analysis. So we'll do a cost benefit analysis of own investing vis-a-vis the mutual fund investing and then decide. Then we learned how do I calculate the return of a mutual fund. How much return do I generate? There are three forms of return. One is capital gain or capital appreciation, which is NAV1 minus NAV0, and there are two forms of dividend paid out of the dividends of the mutual fund, dividend paid out of the capital gains of the mutual fund. In practical world, it's just called dividends. There's no separate bifurcation at all. NAV1 minus NAV0 plus D1 plus CG1 whole divided by NAV0 into 100. If you do into 12 by M, you get the annualized return. If you do IRR, then it's the effective, then it's the sometimes the return can also be calculated based on IRR. Then we'll have to compute IRR with one positive NPV and one negative NPV. This all these things we saw in the previous session as far as the return part of is concerned. The return we calculate the holding period return. Then we learned that there are three types of schemes which are there in a mutual fund. One is a bonus scheme where the number of units will keep increasing whenever a bonus is issued. Second is a dividend reinvestment scheme. Under a dividend reinvestment scheme, what is going to happen is the sorry under a dividend reinvestment scheme, what is likely to happen is the company will keep paying dividends. The mutual fund will keep paying dividends. I don't get the dividend income. I will reinvest it and get extra units. So we'll have to compute the closing units. After computing the closing units, finally we calculate return. The final realization, what I get, can get reduced by one. There can be a securities transaction tax. There can be short-term capital gain. There can be brokerage expense. There can be long-term capital gain. All these you subtract, you'll get the net realization. Subtract the investment made, you'll get the overall return for the holding period, convert into percentage, and then annualize the return. We also saw some reverse working question with the NAV part. Let's come to 13. It's a very simple question. Let's come to 13. Unit price of an equity linked savings scheme of a mutual fund is rupees 10. Public offer price is 10.204. Redemption price is 9.8. Calculate front end load and back end load. Now I'll explain first these two terms. Front end load is also known as entry load. Front end load is otherwise called as entry load, and back end load is otherwise called as exit load. Entry load and exit load. Now I want to buy mutual funds worth 10,000 rupees. The MF will say you have to pay 10,100. You will have to pay 10,100. That extra 100 rupees is the front end load which will be paid by the investor. Front end load has been eliminated by AMFI. AMFI is Association of Mutual Funds of India. There is no front end load which exists in the practical world. That has been removed. I think it got removed in some 2009. Prior to that, the front end load used to be there. Back end load still exists. Back end load is still existing. Now what is back end load is exit load. I invested in a mutual fund today. I invested some 1 crore rupees, let's assume, in a mutual fund. Now the mutual fund wouldn't want the investors to take out money at a frequent basis. They don't want, or at shorter intervals. You invest 1 crore today, in 2 days you want to take it out. You want to take that money out. practically allowed, but there's going to be a penalty for you. That penalty is called exit load. Now, why is this exit load charges? The mutual fund collects money from a lot of people. What it will do is it will invest this money in certain instruments. It's not going to keep it as cash. Some proportion of it will be kept as cash, but major proportion of it will invest. So if you invest today and immediately ask for redemption in 2-3 days, many people start doing that. Then whatever investments the mutual fund has done, they may have to liquidate those investments, because the mutual fund has to pay money to the unit holders. The unit holders is in need of money. So if I have to pay to the unit holders, I need cash. If 100 rupees is my assets, in that 100 rupees, normally 1 or 2 rupee will be the cash. So if 1% people are asking for redemption, I don't have a problem. But if many people ask for redemption, then I'll have to sell the investments which have been done. That may be the right time to sell, may not be the right time to sell. So I don't want to encourage people doing so much redemption. The redemption should not happen so much. So I want to discourage that. That is what exit load is there. The exit load is normally in the practical world 1%. Some places it's 0.5%, and there is a time limit. That is, if you redeem certain categories, if you redeem within 7 days, exit load is there. Within 30 days, exit load is there. Within 1 year, exit load is there. Within 2 years, there are certain MF which say if you withdraw within 2 years period, we will charge you exit load. Beyond 2 years, no exit load. Beyond 2 years, some funds beyond 1 year, some funds beyond 30 days. Now, 10 plus the entry load is 10.204. 10 plus the entry load or the front end load, you'll have to calculate the percentage, is 10.204. 10 minus the exit load is 9.8. 10 minus the exit load is 9.8, which is your redemption price. So 10 plus the entry load and 10 minus the exit load. 10 minus the exit load. Clear? Any doubts on this? Any doubts on this part? Let's write. Computation of front end load and back end load. Front end load and back end load. Public offer price is equal to unit price plus front end load, unit price plus front end load, plus front end load. What is the public offer price? 10.204. 10 plus front end load. Your front end load is 0.204, that's of no use, or 2.04 percentage of 10 rupees. 2.04 percentage. Practical front end load has been removed. Front end load has been removed, at least in the India's context. There are no entry loads which I've seen in the recent times. Front end load is 2.04 percentage. Any doubts on this? Next, redemption price is equal to unit price minus back end load. Unit price minus back end load, or technically the exit load. Unit price minus back end load or the exit price. Back end load or the exit price. 9.8 is equal to 10 minus back end load. Back end load is 0.20 or 2%. 0.20 or 2%. Clear? Any doubts on this? Any doubts on this part? Clear? Can you proceed? 14 is homework. Okay, I'll move to the second segment of the chapter, which is going to focus on calculating NAV. Now, NAV calculation is nothing but calculating the book value of a share. You could have come across this term called as book value of share. What is book value of share? Is share capital plus reserves and surplus divided by number of shares. Share capital plus reserves and surplus minus if any fictitious asset. This is one way of calculating the book value. If you look at your balance sheet, on the balance sheet side, I'll have share capital, reserves and surplus, loans, current liability, fixed assets, current assets. Let's leave it like this. So you can say your book value per share is share capital plus reserves and surplus. If anything like this there, P&L debit balance, if anything like that is there, you subtract that. Okay. The other way of calculating this is fixed assets plus current assets minus current liability minus loans. Fixed assets plus current assets minus current liability minus loans. P&L anyway we are not adding, so no point of subtracting that. So there are two ways of calculating your book value per share. One is share capital plus reserves and surplus divided by number of shares, or fixed assets plus current assets minus current liability minus loans. NAV of a unit is equal to all assets minus liabilities, all assets minus liabilities. The only thing is we go with market value of assets. We go with market value of assets. No concept of book valuation. Every day share price will change, value of assets will change, NAV will change. On a daily basis, the value of the asset side will undergo a change. How does it undergo a changes? If the underlying shares go up or come down. If the underlying shares are increasing or reducing, you will see a change in the value of the asset side. So the formula for a NAV per unit is market value of assets. Market value of assets less settlement value of liabilities. If any liabilities is there, how much are you going to pay? Or you can technically say less liabilities. We don't adjust anything on the liability side. We don't do any adjustment on the liability side. There will be certain expenses. We consider those expenses. Some outstanding expenses can also be there. So whatever expenses are there, you consider all those expenses. After considering the expenses, you end up calculating the NAV. You end up calculating. Once you subtract this, you get net asset value of the fund. What is net asset value of the fund? Is value of all units. Value of all units. Divide by number of units, you will get the NAV per unit. Divide by number of units, you will get NAV per unit. Clear? Any doubts on this? The only thing is every item has to be valued as per the market price. Now, what can happen in some exam question is they can test your understanding of share valuation, bond valuation in a mutual fund chapter. That is, they can give some data and they may give data to value the share as per Gordon's model. The share is not valued by them. You have to value the share as per the Gordon's model. In the practical world, I go by market price. I go by market price. If they don't give the market price and say the current market price is equal to the fair value, they may give some data on bond side and tell you to value the bond as per present value of future cash flows discounted at investors required rate of return. If you remember, there was one problem on bond valuation where I had to use the concept of volatility and adjust the value and calculate the NAV per unit. I had told you I'll discuss about NAV later on when I come to mutual funds. But that question is technically combining the concept of mutual fund along with your share valuation. So an exam question can test share valuation, bond valuation in a mutual fund. Share valuation, bond valuation in a mutual fund, because first job is to do the valuation of all the assets. Many question will give you the values directly. That is, they'll say this is the market price. So consider that market price and do the calculation. So many question, the values are going to be done directly. The value part is going to be done directly from an exam situation, there will be only few questions where you will be required to do use the concept of security valuation and complete the valuation of the asset side. Clear? So very simple, NAV per unit is equal to value of all assets minus value of liabilities divided by number of units. Value of all assets change daily. Liabilities may or may not change. Units can also change daily. Units can also change daily because new people will come into the mutual fund. Some people may exit the mutual fund. Some people will exit. So in a practical world, what happens is whenever I am trying to enter into a mutual fund, I will never know the NAV at which I am entering. Why I don't know the NAV at which I am entering this? Today, if you buy before, I think the cutoff is 2:30. Today, if you buy before 2:30 p.m., the if the MF gets the fund by that time, if there is an instant credit on the MF account, they will allot you units by end of day, and that will happen at end of day NAV. That will happen at end of day NAV. The end of day NAV you will not know, but anyway, obviously you know what happened. The last day NAV will be there. Today, whether if the market is going up, if Nifty is up, your MF NAV will mostly go up. If Nifty is down, MF NAV will be down. If it's based on Nifty, some MF will be based on small cap, some based will be on large cap, some will be on mid cap. But basic thing is NAV is something which has to be calculated on a daily basis. NAV will be calculated on daily basis, and you will see changes happening on the asset side, on the liability side, as well as on the unit side. Everything can undergo change. Let's look at this in few questions now. Let's come to 15. Calculate today's NAV of ABC fund if the following details are given. Yesterday's NAV, total number of outstanding units, face value, expenses, appreciation, fresh subscription, redemption, dividend received. Go through this. Okay, we are required to calculate NAV of the ABC fund. They have not given all assets, liabilities, and all. They have given yesterday's NAV and yesterday's units. NAV into the number of units is net worth. NAV into number of units is the net worth. So I have yesterday's net worth. Yesterday's net worth will go up if there is appreciation. If there is appreciation, it will go up if there is some income. It will go up if new people are coming into the fund. I am talking about the overall net worth. I am talking about the overall net worth. If anybody enters the mutual fund, again the net worth will go up, but the denominator will also go up. Per unit may not have much impact. Per unit may not have much impact. So I'll start with yesterday's net worth, add items which are increasing the net worth, deduct items which are going to reduce the net worth, get the closing net worth. Closing net worth divided by closing units. What is closing units? Is yesterday's units plus any new entry minus any exit. Any new entry minus any exit. Let's write working note 1, computation of NAV. Computation of NAV. Particulars calculation amount. Starting point, yesterday's net worth, that is the starting value. You can write it as yesterday's net asset value of fund. Or let me use the word opening NAV of fund. There is something called as NAV per unit and NAV of fund. NAV of fund is value of all assets. Value of all assets. How many units are there? 125 lakhs into what is the opening NAV? We'll do this in lakhs. 125 into 12.87. Opening NAV of fund 125 lakhs into 12.87. There are multiple items which will increase the net worth. Add is, what are the items which are going to increase? Sorry, portfolio first appreciation. There's a portfolio appreciation which has happened. Portfolio appreciation 12 lakhs. Portfolio appreciation 12 lakhs. Add fresh subscription. Fresh subscription. How many units are there? Ideally, in a practical, this will happen at closing NAV, but I don't have the closing NAV, so I'm assuming it happens at opening. I'm assuming it happens at opening. In a practical world, this will happen at the closing NAV. This will happen at the closing NAV. 2 lakhs into 12.87. 2 into 12.87. Anything else which is going to increase the net worth? Any other item which can increase the net worth? Sorry, there is one more item. Dividend received. Dividend received. Dividend received. This is going to increase my asset side called as cash. This is an income. So any income will increase my asset value and indirectly increase my net worth. Dividend received less any item which is going to decrease the net worth. Sorry, expenses less redemption. How many units redeemed? Point into 12.87. Redemptions 0.75 into 12.87. Closing net asset value of fund. Closing net asset value of fund. Closing NAV of fund. Expense is going to reduce my reserves and surplus, no? Yeah, correctly. It will reduce cash. No, the balance sheet has to tally, no, anyway. No, no. So the difference between asset and liability is the equities, no? That is the balancing figure. So earlier, what used to happen? Assets were 1,000 lakhs. Outside liability was 800 lakh. Net worth was 200 lakh. Now assets come down by 1 lakh. Outside liabilities continue to be same. Equity is going to come down. Any doubts on this? Clear? Can you proceed? Any doubts on this part? Closing units. Closing units 125 plus. What is the fresh subscription? Exit 126.25. 126.25. That's the closing value. 126.25. The closing amount is 126.25. and finally we get closing NAV. Closing NAV 1636.8375 divided by 126.25. Practical world NAV can be 4 decimals, sometimes even more than that also, depending on the per unit values. Closing NAV is 12.9650. The closing NAV is 12.9650. Any doubts on this? Clear? Can I proceed? Any doubts on this part? Go through question 16. Go through this question. Go through 16. On 1st April 2009, it had the following assets and their prices at 4 p.m. is given below. Shares, multiple shares are there and their prices, number of units. NAV of the fund is basically, you will first calculate the overall net asset value of the fund and divide by the number of units and get NAV per unit. NAV at a per unit level. Assuming Mr. X sends a check of 50 lakh, what will happen to the question? And calculate the revised NAV if there are changes in prices. When prices change, automatically the NAV will undergo a change. Automatically the NAV will undergo a change. Let's do the calculation. Working note 1, computation of NAV. Particulars calculation amount. Computation of NAV. Capital A, value of assets. Last question, we kind of did it through the liability side route. How I did it through liability side route is, I had the share capital plus reserves and surplus. I kept on adding items which will increase that value, kept on deducting items. Now we are going to do value of all assets minus any liabilities, and get the net asset value. Shares of A Limited. You can keep writing them. Number of shares is there. Multiply with the share price. 10,000 into 19.70 into 19.7. Keep writing them. Nothing for me to explain as of now. Shares of B Limited. 50,000 into 482.6. C Limited. and shares of E Limited. There's no major analysis to be done in part 1 of the question. Values are given. Values are there in the question. We just need to take them and then complete it. Any doubts on this? Total value of assets. Total value of assets. Some 9 crore 52 lakh 38,000. Value of assets is 9 crore 52 lakh 38,000 less liabilities 0. There are no liabilities in this question. Let me know if you get stuck somewhere. Liabilities is not there. Net asset value of fund, or you can say net assets of fund. Net assets of fund. Net assets of fund. Number of units. NAV per unit. Number of units. NAV per unit. How many units are there? 8 lakh. 119.0475. That's the NAV. 119.0475. We consider all the assets, deducted liabilities if any, and get the value of the fund, divide by the number of units. This net assets of fund is practically also known as assets under management, AUM. Assets under management. How much is the money which they are holding for people's, or how much money are they holding of the investors to manage? Any doubts till now? Next, working note to revised position of the fund. Revised position of the fund. Just you will have 4 columns. Okay, there will be 2 amount columns. I'll explain the other amount column later. 2 amount columns will be needed. Now first let's understand the question and then come to this. Assume Mr. X sends a check of 50 lakhs to the fund manager, and the fund manager purchases 18,000 shares of C Limited. Balance is held in bank. What will be the position of the fund? Now somebody is going to make an entry into the mutual fund. So I am going to allot units to him. I'll allot units at the NAV which I have calculated. I will allot units at the NAV which I have calculated. Whatever NAV we have calculated, that at that rate will allot the units. This 50 lakh, what I did is I ended up buying the shares of C Limited. I ended up buying the shares of C Limited. They have not mentioned at what price did we buy. At what price is not mentioned. I am going to assume that I purchased at the closing price. Purchased it at the closing price. Technically slightly incorrect. Why it's slightly incorrect is you will get to know the NAV by end of the day. NAV by the end of the day. If NAV is known at the end of the day, that NAV, if you are using for units allotment, if you are using that NAV for the units allotment, this 50 lakh, I don't know at what time it came. If it has come after 4 p.m., then there's no possibility for me to buy the shares on that day because the trading would get closed. But now what we are going to do is, in this question, no change on A Limited, no change on B, no change on D, no change on E Limited. Nothing is going to change. C Limited number of shares will go up. C Limited number of shares will go up. There can be a balancing figure of cash. There can be a balancing figure of cash because you got 50 lakhs. You got 50 lakhs. In that you have purchased some shares. You have purchased some shares. that if I have taken some 45 lakhs, cash can be extra 5 lakhs. There can be a cash balance of 5 lakhs. Nothing on the liability side. Net assets of fund will go up. Number of units will go up. NAV per unit will remain same. NAV per unit will remain same. Now, why does it remain same? Is NAV can change only if there is changes in the value of underlying asset or liability. Value of underlying asset or liability. Just because somebody is coming in, NAV is not going to increase, NAV is not going to decrease. NAV is not going to increase or decrease just because people are making an entry. Only one reason where it can increase or decrease because of people are coming in is if there is any entry load or exit load. Because entry load is technically the income of the mutual fund. Entry load is technically the income of the mutual fund. Exit load is also their income. Exit load is also their income. So, in case a person makes an entry and pays an entry load, NAV can change. So, in a practical world, NAVs don't change because of people coming in or people going out. But on a daily basis, it changes. The reason for changes, share price of A limited from 19.6 can move up to 20 or 18 or 16. When that happens, you will see a change. When the share price changes, you will see a change in the value of the fund and the NAV per unit and the NAV per unit. So repeat this calculation. Shares of C Limited alone will change. So try to fill this. Shares of C Limited will undergo a change. Shares of C Limited will undergo a change. There's another amount column, I'll touch upon that in some time. Another amount column I'll discuss in some time. You write A Limited same figure, B Limited same figure. C will undergo a change, cash will be there. Yep. Sorry for him. If he's purchasing in the open market, okay, okay, you have touched upon something which, okay, there's something called as when I want to buy in a mutual fund, there is a open-ended mutual fund, a close-ended mutual fund. So there are two types of funds. If it's a close-ended fund, you will not buy it from the mutual fund. You will buy it in the open market. When you buy this in the open market, when you buy this in the open market, technically I am buying and you are selling. I am buying and you are selling. Mutual fund does not get any money. Mutual fund does not get any money. If they don't get any money, they cannot manage any further funds. So that happens in a close-ended mutual fund, which will be traded in the market, and the name for that is called ETF, exchange traded fund. That use a term called as ETF. So any mutual fund which is listed and traded in the market is called ETF. Open-ended funds mostly don't trade in the market. Mostly don't trade in the market. See, what is the purpose of trading in the market is you want to give an option of exit to a person. So if, for example, we say share as perpetual life, but still I can exit from a share. I can exit from a share by selling it because there is another buyer who is going to be there. Unlisted shares, exit becomes difficult because we may not find a buyer. So exchange traded funds are those mutual funds where what happens is you are buying the mutual fund. I will not get the money from you. I am the mutual fund. I'll not get money from you. You are buying, your friend is selling. So you buy, he sells. In fact, in a practical, you may not even get to know whom is buying, who's selling. Same like your trading of shares. Same like trading of shares, you will not know who is buying and who is selling. Here, Mr. X is giving money to the fund. Is giving money to the fund. He'll be allotted extra units. He'll be allotted extra units, and using that money only I'm buying the shares. Using that money I'm buying the shares. Assume Mr. X buys the units from the market. If they say buys the units from the market and it's a close-ended fund, then my answer for part 1 and part 2 remains same. Nothing changes. I cannot change anything because underlying value of assets don't undergo a change. I don't buy any extra shares. There's no change in the number of units, so nothing is going to change. Okay, any doubts on this? Shares of C Limited, how many shares were there earlier? Now 28,000 into what is the price? 264.40. Cash is 50 lakh minus 18,000 into 264.4. Assumption is shares were purchased at the closing price. Assumption is shares have been purchased at the closing price. I have paid 18,000 into 264.4. 18,000 into 264.4. Any doubts on this? If you check, your net value of assets would have exactly gone up by 50 lakh rupees. The value of assets would have gone up by 50 lakh rupees. Last time whatever value you had, now it would have gone up by 50 lakh rupees. Any doubts on this? Any doubts till now? Clear? Okay. Now coming to the number of units. Okay, this is also one doubt which many students have asked me. Any doubts till now? You write till this. I'll come to number of units. Complete till this. I'll proceed ahead now. Now, what is the units in part 1 of the question? 8 lakhs. So this is, I don't know, it leads to a lot of doubts from students. Many students add 18,000 to this. 18,000. What is 18,000? Is shares allotted. 18,000 is shares allotted. Now, be very clear. You are not the owner of the final shares. You are not the owner of the final shares. The mutual fund is the owner of the shares, and to you shares will not be allotted. If you are buying a mutual fund, you will not get the, you are technically a beneficial owner of all those shares. You are technically a, this mutual fund would have invested in 100 companies. You are technically now a shareholder of all the 100 companies. You are technically a shareholder of all the 100 companies, but you cannot go to the meetings and attend it because you are not technically, you are not, from a legal point of view, you are not the shareholder. You are technically a beneficial shareholder, because if the mutual fund holds 100 companies and you hold 1% of the mutual fund, so whichever companies they are holding, you're indirectly holding 1% of their holding. You're indirectly holding 1% of their holding. But you cannot become owner of the company. You cannot get any voting rights. You will not get any dividends. The mutual fund will get dividends. They can distribute to you if they want. They can distribute to you. Now, 8 lakh was the opening units. Number of units never goes up by the shares allotment. Never goes up by the shares allotment, because this has been doubts by many students. They end up adding 18,000. This 18,000 is the shares purchased by the mutual fund. What we are calculating is units. So 8 lakh plus 50 lakh. What was the NAV you computed in part 1? If my opening NAV is 119.0475, new people come into the mutual fund, you allot them at 119.0475, no assets change, no liabilities change, NAV, closing NAV also will not change. Closing NAV also will not change, because your opening, simple thing is 8 crore is the value for 8 crore units, value is 9 crore 52. Value went up by 50 lakhs. Value went up by 50 lakhs. You will see proportionate increase in the units also. Proportionately, the units will also go up. Proportionate increase will be there. NAV will remain same. So 8 lakh plus 50 lakh, 119.0475. It remains 119.0475. Wait for a minute. Just give me 2 minutes. Now, this is how the practical NAV is 153.9878. The NAV will have decimals. The NAV is going to have decimals. Now, when normally what people do is when they invest in mutual fund, they don't say that I want to buy 2 shares, 2 units, 3 units, 5 units. What they say is I want to buy 1,000 rupees mutual fund. So units allotted will be 1,000 divided by 153.9878, which will again be in decimals, which will again be in decimals. So the number of units will be in decimals. The NAV will also be in decimals. The NAV will also be in decimals. You see an item called as fund size. This fund size is nothing but all assets minus liability. All assets minus liability. The NAV of the fund. You see another item called as expense ratio. This is your recurring expense ratio, which we had done in the earlier calculation. The recurring expense ratio, we had an own return versus a MF return calculation where we used to take expense ratio. And there are two types of mutual fund. There's something called as a regular fund and a direct fund. Regular fund will have a slightly higher expense ratio. I'm not sure if this is not changing. Okay, ideally the regular fund will have a slightly higher expense ratio and direct will have a slightly lower. You will understand about regular direct if you just read about it. It's not needed from a problem solving point of view. So the NAV has to be in decimals. Units will also be in decimals in the practical world. Units will also be in decimals in the practical world. Now, just give me a minute. Now, this is how the fund has been investing. They invest in large cap, they invest in mid cap, they invest in small cap. This would have been defined in the fund scheme. They'll give an objective. The objective will define how are they going to invest it. How are they going? The name of the fund is Quant Small Cap Fund, but small cap investment is only 60%. Balance has gone to large cap and mid cap. Large cap and mid cap. Some part of it could be in the form of cash also. Some of it could be in the form of cash. 95.91% they've already invested. That's what they're saying. 95.91% has been invested. Balance could be in the form of cash, or sometimes they may buy some securities and all, some fixed securities and all. And people may also do international investments. Instead of only investing in India market, you may even go and invest in the international markets. Now, these are the historical returns of the fund. This is the last 1 year return. You can get the data for not only last 1 year, you can get it for any period. The annualized return, 1 year is 15.77, 2 year is 48, 3 year is 55, 5 year is 24, since inception is 16.42. You see the returns for the last few years, the 1 year, 2 year, 3 year period to be very high. That's more because of COVID. Because in between, if a person has invested in the month of March 2020 and all, the returns would be on the very higher side, because during COVID time, the markets crashed big time. So a 3 year return is some 55%. Those are highly abnormal returns. Mutual funds don't give such high return. But since inception also, the fund has given some 16% return. You look at the absolute 5 year, 198 percentage is the holding period return. You see that absolute return, that is the holding period return. We will say 198.97 into 12 by m and calculate the return. That will be some 40%. That 40% is of no use in the practical world, because the IRR is 24.47. IRR is 24.47. In the practical world, returns basically mean IRR. Returns basically mean IRR. There's no point of calculating the annual return which you do. There's no point of calculating the annual return which you end up doing. But in exam you will present it that way only. But what is the ideal way of calculating the return is IRR mode. You have to go through the IRR mode. Since inception, I think it's broadly some 8 years or so. In 8 years, they have given 351% return. You'll say 351 by 8 and say it's a very healthy return, but it's only 16%. 16% as such is also healthy return only. 16% as such is healthy return, but the point is the annual return which we calculate is not the right indicator. So the only reason I've shown you this in the practical world part is, one, your NAV per unit will be in decimals. Second part is units will also be in decimals, and NAV will change every day. This is 7th December 2022. So this could be the closing price, which would have, or this is has undergone a change, point minus 0.01. Just give me a minute. If I have the NAV on a daily basis, I'll show that. I don't have the NAV, historical NAVs in this. Just give me a minute. Okay, this is indirectly how the NAV has undergone a change. This is indirectly the change in the NAV. It go okay. This is returns, not the change in the NAV. This is the percentage returns the mutual fund makes. You could see it even reaching 0%. It can even reach negative also. It can reach 0%. It can even reach negative also in the practical world. Now, in this question, there is no change in NAV for part 2 because underlying assets are not undergoing a change. Right till this, complete till this. Again, I'm repeating, number of units is what is allotted to us, not the shares. You cannot add the shares part of it. Okay, there is a revised, there's another amount column which I told you to calculate. I have this amount in bracket, you can write April 2. I'm calculating the NAV of April 2 using this amount in bracket April 2, amount in bracket April 2. Any doubts on the original calculation? Okay, April to 10,000 into the price will change. What is the share price of A Limited? This can change my final NAV. 10,000 into 20.3, 50,000 into 513.7, 513.7, 28,000 into 290.8 into 290.8, 1 lakh into 671.9 into 671.9, 30,000 into 44.2. The value of the assets are undergoing a change because of what's happening in the market. Because trading happens in the market, with that, the value of assets can undergo change. Same amount of cash, value of assets have gone up. It can come down, it can go up also. It can happen either ways. There is an increase in the value of assets. There can be a decrease as well. Clear? Liabilities is 0, net asset value of fund, number of units remains same, NAV increases. NAV has increased in this example, it can even decrease. NAV has increased in this example, there can be a decrease in NAV as well. Any doubts on this? Clear? Can you proceed? Any doubts on this? Done? Let's come to this. Mr. Sinha has invested in three mutual fund schemes as per details below. Date of investment, amount of investment, NAV at entry date, dividend received up to 31/3/2012, NAV at 31/3/2012. You are required to calculate the yield on per annum basis in respect of the three schemes to Mr. Sinha up to 31/3/2012. Go through the question. Okay, the question wants us to compute the returns of the three mutual fund. Ideally, I could have shifted this question to part one of the chapter, which is computation of return, rather than discussing in this part. It's technically a question belonging to that part. It's not the NAV calculation to be done here. Now, what is return is, I can say NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 12 by M into 100. The dividend, they have mentioned 9,500. I want per unit dividend. I want per unit dividend. Or what I can do is, NAV1 is value of my all units. NAV0 is value of all my units. Whatever. Instead of doing per unit calculation, we'll do the calculation for all units. So here I'm going to use the formulas: what I get back minus what I invest divided by what I get back into 12 by M into 100. Now, what ICI does is, whenever the exact date of investment is available, they do the calculation on days basis. They do the computation on days basis rather than doing it on months basis. So this also, there are people who have lost marks because they have not followed this ICI part, but technically doesn't make any big difference whether you do the calculation in days or in months. So we are going to calculate the returns. The formula is what I get back minus what I invest divided by what I invest into 12 by M into 100. Working note on computation of return. Just give me a minute. Computation of return. Particulars and three investors. Particulars and three investors. We can do even at a per unit level also. Doesn't make a difference. You will get the same answer. Rounding off part will be huge there because the dividends will turn out to be in decimals. So that's the only thing. Point number one: amount invested. Amount invested. How much did we invest in scheme X, Y, and Z? 5 lakhs, 1 lakh, 50,000. 5 lakhs, 1 lakh, and 50,000. Amount invested 5, 1, and 50. Opening NAV. Opening NAV 10.5, 10, and 10. This will give me the units allotted. Why I am calculating units allotted is, units allotted into the closing NAV is my closing value. Units allotted into the closing NAV will give me the closing value. Closing value plus dividend minus opening value is my return. Closing value plus dividend minus opening value. Closing value is NAV1, opening value is NAV0. Point number 3: units allotted. We'll work with two decimals. You can even do four decimals also. I'll work with two decimals for units allotted. Forty-seven thousand 619, 10,000 and 5,000 units allotted. Closing NAV. Closing NAV. What's the NAV given? 10.4, 10.1 and 9.8. Maturity amount, which is units allotted into closing NAV. Maturity amount, units allotted into closing NAV. Units allotted into closing NAV. Again, we'll work with two decimals. Now, whatever maturity amount you have calculated, that's technically NAV1. That's technically NAV1. And whatever you invested is NAV0. The gap between that is capital appreciation or depreciation. The gap between that is capital. There are three incomes. First income is capital appreciation, which is NAV1 minus NAV0. Second income is dividend. Third income is CG1, capital gain 1, which is basically dividends paid out of the capital gains. Point number 6, capital appreciation. 5 minus 1 can be negative as well. Capital appreciation can be negative as well. Capital appreciation. Capital appreciation. Dividends for the three schemes are 9,500, 1,500 and nil. 9,500, 1,500 and nil. 9,500, 1,500 and nil. That's the dividends we are generating. That's the dividends we are generating. Return in rupees. Return in rupees. What is return in rupees is NAV1 minus NAV0 plus D1 plus CG1. NAV1 minus NAV0, which is your capital appreciation, dividends. Clear? Holding period return percentage. What is holding period return is, don't consider the time period. We don't bring the time period into picture. Later on, I'm going to bring the time period. Later on, I'm going to bring the time period. NAV1 minus NAV0 plus D1 plus CG1 divided by amount invested. Divided by amount invested. 0.95, 2.5 and negative 2. 0.95, 2.5 and negative 2. Holding period return. Holding period return. Ignoring the time period part. Now I could have got this faster also instead of doing all this calculation, but maybe there will be some step marks associated with this. That's why I've done this calculation. How I could have calculated this is, scheme Z is the easiest. Let me first quickly show. 10 minus 9.8 by 10 into 100. NAV1 minus NAV0 plus D1 plus CG1. There were no dividends. 10 minus 9.8 divided by 10 into 100. 1500 is the dividend received. How many units scheme Y we allotted? How many units allotted in scheme Y? Yeah, please tell me. Scheme Y units allotted. 10. So NAV1, sorry, this 9.8 minus 10. 9.8 minus 10. The closing NAV is 9.8, the opening NAV is 10. In this case, 10.1 minus 10 plus 15 paise. What is 15 paise? Is 1500 divided by 10,000. 1500 divided by 10,000 into 10 into 100. Similarly, scheme X, dividend per unit is 9,500 divided by the number of units allotted. If you do two decimals, it will lead to a lot of rounding of gap. The dividend will calculate maybe some 5-6 decimals and then apply the formula. You will get the same 0.95%. You will end up getting the same 0.95%. So what we have indirectly used is NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 100. Any doubts on this? Number of days of investment, annual return. Now listen, technically I can still do this problem in months. I can still do this problem in months despite the giving the date of investment. Sometimes ICI does that also. So when you write your final answer, you can say alternatively this can be calculated in months. Any problem if they say number of days to be taken as 360, then it doesn't make any difference whether it's months or days, because 12 months is 360 days. 12 months is 360 days for our calculation. Some question will say assume or take 1 year equal to 365 days. Take 1 year equal to, if that line is there in the question, you should do always days calculation. Anywhere, not only in mutual fund, you may see this in futures valuation later. You may see this in your options valuation. Anywhere if they use the word take 1 year equal to 365 days or 366 days, you will have to do the calculation only in terms of number of days. When I do number of days, the only difficult part is should I consider 112 or should I exclude 112? I don't know, because it depends on whether you made the investment on the beginning of the day or at the end of the day. Beginning of the day or at the end of the day. When I did money market, there I told you the rule very clear. Money market, we normally consider the last day, ignore the entry date. Consider the last day, ignore the entry date. I'm not very sure what is done in mutual funds. I'll just check what they have done in this question, but it can be assumption. It can be assumption. You can consider 112 2011 in the calculation. You can ignore 112 2011 from the calculation. You can consider as well as ignore it. Similar 31 3 2012 should ideally be considered because that will be the closing NAV. That will be the closing date. So last date will be considered in most of the situation. Now entry, when did we make is the point. Did we make it on the beginning of the day or at the end of the day? If you have made an entry at the end of the day, 112-2011 is not to be considered in the days calculation. 112-2011 is not to be considered. I am as of now considering both the days and writing the answer. We'll see what has been done in the solution. I cannot give a consistent answer for this. At least in money market, I told you consistently what will be followed. But here I'm not very sure. I'm not very sure what would have been done. For example, scheme X, 31 days of December, 31 days of Jan, 29 days of February, 29 days, 2012 leap year, 31 days of March. Tell me the number of days. 122. I am assuming that I made the investment at the beginning of 112-2011. I made the investment at the beginning of 112-2011. Scheme Y, 31 days plus 29 days plus 31 days. How much? 91. Scheme Z only 31 days. Scheme Z only 31 days. I told you the formula is into 12 by M. Now it is 366 by D. Why 366? Leap year. 366 divided by D. D is the number of days. D is the number of days. So whatever return you calculated, if you do into 12 by M,
you will get the annual return. Instead of doing 12 by m, you will have to do 366 by the number of days. So 0.95 into 366 by number of days. 0.95 into 366 by number of days. My assumption is opening investment happened at the beginning of the day. Happened at the beginning of the day. So opening day and closing day both are considered. Any doubts on this? Now, this is what ICA would want you to do. But if I do it in months, annual return using months, nothing much is materially going to change. 0.95 into 12 by 4 months. 0.95 into 12 by 4 months, because 4 months of investment. We made 4 months of investment. 2.5 into 12 by 3 months. Into 12 by 3 months. Negative 2 into 12 by 1 month. You will not see a big difference and all. You will not see a big difference. But in an exam situation, if the date of investment is available, you can, if the question specifically says take 1 year equal to 365 days, nothing to think about. You will have to do only days calculation. Alternatively, if time permits, do both. Time permits, do both. But else, annual return in days is fine. But it's not consistently followed. That's the only thing. If it was consistently followed, I would have given you one guidance. There's no consistency on this part. Wherever that word 1 year equal to 365 days is given, there consistency is there. There the consistency part is there. Any doubts on this? Clear? Can you proceed? Any doubts on this? Okay, a similar question with certain changes here. Okay, a similar question. In fact, a question like this has already come in exam. The next question in your material would be like this only, but this has certain extra adjustments, so that's why I wanted to discuss this. Mr. Y has invested in 3 mutual funds as per the following details. Amount of investment 2 lakh, 5 lakh. This is in the additional material. Okay, 2 lakh, 5 lakh, and 4 lakh. This is page 9. 2 lakh, 5 lakh, and 4 lakh. NAV at the time of purchase 10, 25, and 20. Dividend yield up to 31/3/2022. NAV as on 31/3/2022. Annualized yield as on 31/3/2022. Assume 1 year is equal to 365 days. 1 year is equal to 365 days. This line means you'll have to do days calculation. Mr. Y has misplaced the documents of investment. He help him in finding the date of his original investment. Number of units, value of his investments as on 31/3/2022, holding period of his investments in number of days, dates of original investment, total return on investment. Assuming past performance will continue for next 1 year, what action should the investor take? What will be the expected return? Will your answer change if the mutual fund charges an exit load of 5% if the investment is redeemed within 1 year? If so, advise the investor what and when the action to be taken to optimize the returns. Go through the question. Okay, this is just one point. This is what I was discussing in the last question. It is assumed that investment is made in morning and hence date of investment will be considered in number of days. Date of investment will be considered in number of days of investment. Annualized yield can also be calculated by multiplying holding period return with 12 by number of months of investment. ICI has calculated return with number of days in this question. That's why I followed it in this problem. I cannot give you consistent answer saying that every time it will be only the number of days calculation. Sometimes they may do even months calculation. Sometimes they may do months calculation. But if that line is there, assume 1 year is equal to 365 days, there they'll consistently follow. Go through this. When we do money market instruments, the date of investment will be ignored in the days calculation. Closing date will be considered. One problem I've done in mutual fund where both dates were considered. We'll see in 2 3 more problems. If consistently they follow this, maybe that's your base assumption. Okay, it's slightly a reverse working kind of a situation. I have my amount of investment. I have NAV at the time of purchase. NAV as on 31/3/2022 is given. With this, I can calculate technically the holding period return. Technically, the holding period return. Holding period return into 365 by number of days is annual return. Holding period return into 365 by number of days. Number of days will be your balancing figure. Number of days will be the balancing figure. So once you get the number of days, you will get the date of original investment. You will get the date of original investment. Okay, they have used the word dividend yield. I said holding period return is NAV1 minus NAV0 plus D1 divided by NAV0. CG1 is same, okay? NAV1 minus NAV0 is capital gain. Capital gain divided by NAV0 is capital gain percentage. Capital gain divided by what you invested is capital gain percentage. D1 divided by NAV0. D1 divided by NAV0 is called dividend yield. D1 divided by NAV0 is called dividend yield. D1 divided by face value is called dividend rate. Face value, if you apply it on the face value, it is called dividend rate. If you apply it on the market price, or if you apply it on the NAV of the fund, then that is called as the dividend yield. That's called the dividend yield. Dividend yield is on the market price. Dividend yield is on the market price. Dividend rate is on the face value. Dividend rate is on the face value. Let's calculate this. Working note 1, computation of number of units, value of holding, holding period, and date of investment. Particulars MFX, MFY, and MFZ. And a total will help me in answering part 5 of the question. Total will help me in answering part 5 of the question. Particulars, 3 mutual funds and a total column. Point number 1, amount invested. Almost going to be similar calculation only. I'm technically going to write almost the similar calculation with some changes here and there. Some changes here and there. Amount invested. How much amount invested in mutual fund X? 2 lakhs. Y is 5 lakhs. Z is total. I'll write it later. I need total only for few rows. I don't need it for all. I'll see it later. 2 lakh, 5 lakh, and 4 lakh. Opening NAV. This is part 1 solution. Part 1 solution is this. 20,000 units have been allotted in all the 3. The number need not be same. Here it is more of 20,000 units have been allotted in all the 3. What's the closing NAV? 10.5. I'll use the term which they've asked in the question, value as on 31/3/2012. 31/3/2022. This is part 2 of the question. This is part 2 of the question. Solution to part 2 of the problem. Part 1 is units allotted. Part 2 is value as on 31/3/2022. Capital appreciation. Okay. Now the question has used the word dividend yield. Dividend yield can be calculated in two ways. One is I invest in MF2, I invest in the shares. Let's go look at practical world shares. You invest in shares today, you'll get the dividend after a year. You'll get the dividend after a year. So dividend yield can be dividend by the investment I made. Dividend by the investment I made. Or I can also say dividend by the closing investment. Dividend by the closing investment. What is the dividend yield of MFX? This 3% can be applied on 2 lakhs, can also be applied on 2 lakh 10,000. Can be applied on 2 lakhs, can also be applied on 2 lakh 10,000. More logical is to apply it on 2 lakhs because that's the investment I made. That's the investment I made. So on my investment, how much dividend am I getting? On my investment, you bought investment worth 2 lakh. They would have allotted units. The face value of these 20,000 units can be 1 lakh rupee. The face value of these 20,000 units can be 1 lakh rupee. On 1 lakh, they will give you dividend rate. On 1 lakh, they'll give you dividend rate. On this, they will give you dividend yield. On your investment, it's called dividend yield. MF doesn't say my dividend yield is so much. They'll only say dividend rate. They are going to talk about only dividend rate. Yield will change for people to people depending on when did they make an entry and what is the investment they made. What is the investment they have made. So dividends is 3% into amount invested. MFY 5% into amount invested. 5% into amount invested. MFZ is 4% into invested. 3, 5 and 4. Clear? Any doubts on this? We have done with part 1 and part 2. 16,000, negative 19 and 32. 16, negative 19 and 32. I'll use the same format only. Holding period return is return in rupees by amount invested. 8, negative 3.8 and 8. Now listen for some time. They've given the annualized return in the question. Listen for some time. The annualized return is 9.733, negative 11.185, 15. Listen for some time. They've already given the returns in the question. Now listen. It's like this. 365 days is equal to 9.733. 365 days is equal to 9.733. Question mark is equal to 8. Question mark is equal to 8. that question mark will give me the number of days of investment. That question mark will give me number of days of investment. T65 is equal to 9.733. Question mark is equal to 8. Question mark is equal to 8. Our holding period return into 365 by number of days is 9.733. You reverse work and get to the number of days. So how will I get number of days is 8 divided by 9.733, cross multiplication, 8 divided by 9.733 into 365 days, into 365 days. We can round off the number of days. 300 days, 124 days and 195 days. 300, 124 and 195. Holding period return into 365 by number of days is annual return. Holding period return into 365 by number of days. This was, I think, part 3 of the question. Holding period 300, 124 and 195. 300, 124 and 195. The holding period return is 8, negative 3.8 and 8. Annual return is given. From there we have kind of reverse worked and got the number of days. Any doubts on this? Date of investment. I'll take the same assumption which we took in the last question, that is 31.3 is also included, date of investment is also included. Let's see if they take some other assumption. So I'll have to do a reverse calculation. 31 days of March, 29 days, sorry, 28 days of Feb, 31 days of January, 31 days of December, November, this is the reverse order, March, Feb, Jan, December. You'll have to do this calculation, you're left with no choice, November. I'll have to deduct 26 days in June. The date of investment is to be considered. The date of investment is to be considered in the calculation. The date of investment is to be considered in the calculation. So I would have made the investment on June 5. If I consider 4, then 4 means 27 days. If you consider the date of investment. If you consider the date of investment in your calculation, I'm taking the same assumption. I don't know what is there in the answer. We'll see in that in some time. If the same assumption is holding good in this question also, it's good. That in both the problem they've taken the same assumption. So I have reverse worked. The date of investment is going to be June 5, 2021. June 5, 2021. 26 days of June, 5th is considered in that, and another 25 days. If date of investment is not considered in 26 days calculation, then it is June 4. Then it will be June 4. So I am taking June 5, assuming the date of investment is considered in the calculation. Basically, I made an entry on June 5, opening day. Next is 124 days. 3 days of November. November 28, 2021. I'll not spend much time on this dates part. You can write this dates. In fact, practical world, I could have just done this itself. 4th June 2021 is excluding the date of investment. Technically, it's excluding the date of investment. So these are two possible answers, either 4th June or 5th June, depending on your assumption, depending on the assumption you take. I don't know what is there in the assumption. Whatever I have written as date of investment is basically the assumption we did in the previous question. The assumption we took in the previous question. The date of investment is considered in the days calculation. Closing date is also considered in the days calculation. I'll see the answer in some time. Later on, we'll see what is there in the solution. Any doubts till this? Any doubts in this? Can you proceed? Let's see what they've ended up doing here. It is assumed that investment is made in evening and hence date of original investment is not considered in period of holding. There I said it's assumed that investment is made in morning and date of investment is considered in the days calculation. Here they have taken an alternative assumption. This is an alternative. That's why I said consistency will not be there. This area consistency will not be there. So answer says 4th June. We have written June 5. Answer says 27 November. We have written November 28. Answer says 18 September 17. We have taken 18 September. So let me see one more problem. If this is what is followed, then whatever we have done in money market instrument, that will be your base assumption. What is base assumption is date of investment ignored, closing date is considered. That will be the base assumption for entire mutual fund. If that is what they follow in one more question, we'll see in one more question. If they end up following that way, okay. If they not follow that way, then I can't help it, because sometimes they assume that the investment is made in the evening, sometimes they made it as investment is made in the morning. Let's look at the last part of the question. Total return on investment. There's something called as total return on investment, which is nothing but, let's add few numbers. Put a total for this. Put a total for amount invested. Put a total for value as on 31/3/2022. Put a total for capital appreciation, dividends, return in rupees. So total return in rupees is 29,000. Total return in rupees is 29,000. The total return which we have earned is 29,000. Holding period return is 2.64%. I'll not get annual return here because the dates of investment are different dates. If it was a uniform date, then I would have done number of days and calculated the annual return. So the total return is 2.64 percentage of investment. Total return is 2.64 percentage of the investment. 2.64 percentage of the investment. Clear? Any doubts on this? Assume past performance of all three schemes will continue for next 1 year. What action should the investor take? What will be the expected return for next 1 year after the above action? You can just listen to it, no need to write it. The answer is there because it will need certain points to be mentioned. Those points will be there in the solution. Now listen. If the same performance is going to continue for the next year, I will sell MFX, I'll sell MFY and hold only MFZ. Hold only mutual fund Z. Or technically I'll sell MFX, sell MFY, put that money in MFZ. Put that money in MFZ and earn 15% return. Earn 15%. If I'm very sure that this is what is going to happen, let me liquidate mutual fund X, let me liquidate mutual fund Y and put the entire money in mutual fund Z. Put that entire money in mutual fund Z. Clear? Any doubts on this? So I'm going to liquidate X, Y and put that money in MFZ. Any doubts on this part? Okay. Will your answer as above changes if the mutual fund charges exit load of 5% if the investment is redeemed within 1 year. If the investment is redeemed within 1 year, if so, advise the investor what and when the action to be taken to optimize the returns. Now, in the first mutual fund, I am earning a return of 9.733. Last mutual fund gives 15%. Obviously, 15% is better. All that is fine. Now, the issue is if you exit within a year, if you exit within a year, you will have to pay exit load. You will have to pay exit load. So, exit load is negative 5%. Exit load is negative 5%. I have to pay an exit load of negative 5%. In this mutual fund, if I wait broadly for 2 more months, if I wait for 2 more months, I can avoid the exit load. I can avoid the exit load. So what I am going to do in mutual fund X is I'll wait for 2 more months and avoid the exit load. Avoid the exit load because mutual fund X is anyway giving me profits. It's giving me profits. So I'll wait for 2 months and avoid the exit load. Avoid the exit load. Mutual fund Y, you will have to wait for 8 more months. You will have to wait for 8 more months. These 8 months is expected to give you negative 7.46%. These 8 months is expected to give you negative 7.46%. How negative 7.46% is? Annual return into you do 8 by 12, you will get holding period. Holding period into 12 by M, you will get the annual return. So for a year, return is 11.18% into 8 by 12 into 8 by 12. I will pay exit load of 5%. I'll pay exit load of 5% and avoid this negative 7.46. Avoid this negative 7.46 because that has a negative. In MFX, I'm ready to wait for 2 more months because reason is I'll avoid 5% and that MF is anyway earning money. For example, if MFX was negative 25% or negative 50%, the negative 50 into 2 months, how much negative you get? So is it okay to pay negative 5 or wait for that period and agree on a negative return? Agree on a negative return, whatever that amount turns out to be. Whatever the amount turns out to be. MFX, I'm okay to wait. MFX, I'm okay to wait. MFY, I wouldn't want to wait. I wouldn't want to wait. There's no major calculation here. If past returns will continue for next 1 year, investor should redeem all the units of A and B and invest in MFC. The return will be 15%. The return is going to be 15%. Are charging investment, then investor should get redeemed units of MFB now and units of MFA after 65 days. Maybe just do that calculation alone. If you have this printed material with you now, write this here negative 11.18% into 8 by 12. Negative 11.18 into 8 by 12. That was negative 7.46. This was more than the exit load. Okay. The loss is more than the exit load. Assume exit load is 10%. I may still hold this fund also. If the loss exit load is 10%, I may still hold this. I may still hold this. It's okay to lose 7% than losing 10%. It's okay to lose 7% than losing the 10%. Any doubts on this? Clear? Let's take a break now. Okay, let's resume now. Okay, 18 is homework. It is a similar question to what we have done here. Similar question to what has been done here. Let's come to 19. Go through 19. Go through question 19. Guys, no discussion, please. Go through 19. Mr. X on 1/7/2007 during the initial offer invested in 10,000 units having a face value of 10 per unit. On 31/3/2008 dividend paid is 10%. Mr. X found that his annualized yield is 153.3. 31/12 20% dividend was given. 31/3 he redeemed all the balance 11,296. We are required to calculate three NAVs: 31/3 2008, 31/12 2009 and 31/3 2010. I purchased how many units? Yeah, please participate. Purchased how many units? 10,000 units. When I exited, how many units are there? 11,296.11. 10,000 has become 11,296.11. This indicates what indirectly? This is dividend reinvestment plan. This is dividend reinvestment plan. This can't be bonus plan. Bonus plan means they have to tell me some ratios and all. They have talked about some dividends paid by the mutual fund. They have talked about the dividends paid by the mutual fund. Now listen, my initial investment is 10 lakh into 10 rupees. Okay, the annual return is 153.33. We'll convert the annual return into holding period. We'll convert the annual return into holding period. Investment plus HPR is the closing value. Holding period return can be directly applied on the investment to get the closing value. Holding period return can be applied. Annual return cannot be applied. For example, in this question, assume dividends were not there. Just assume dividends were not there. Holding period return is 5%. So I can say closing value is 2 lakh plus 5%. 2 lakh plus 5%. Here also dividends not there. Closing value is 5 lakh minus 8.8%. 5 lakh minus 8.8%. But you cannot apply the annual return. You cannot apply the annual return on the base amount. Annual return cannot be applied. So what I can do is I have the opening value. What is opening value? Is 10,000 into 10 plus HPR for 1/7/2007 to 31/3/2008 holding period return will give me the value as on 31/3/2008. Will give me the value as on 31/3/2008. Using that, I'll get the NAV as on 31/3/2008. That's one part. Okay. Then from 31/3/2008, they have also asked for the NAV as on 31/12/2009 and 31/3/2010. Three different NAVs have been asked. First NAV, I have told you what needs to be done. Third NAV also I can do it using that. What is third last NAV is I have the opening investment plus HPR for that entire 2 to 3 years, whatever is the time period. Whatever is the time period. Holding period return for 3 years, if you add, you will get the closing value. You will get the closing value. Divide by the closing units, you will get the NAV. In between, one NAV is missing. How do we compute? We'll understand in some time. Let's start. Working note 1. Computation of NAV as on 31/3/2008. NAV as on 31/3/2008. Particulars and amount. Now, this question, the date of investment is available, but ICA has done months calculation. ICA has done months calculation. They did not get into days calculation in this problem. I cannot explain why not days calculation for this and why did I do days calculation for one other question. So consistency is not always there, but if that word is there, take 1 year equal to 365, there they consistently follow. Point number 1, amount of investment. Amount of investment. How much the investment we have done? 1 lakh. Annual return from, what is the date of investment? 1/7/2007 to 31/3/2008. Annual return from 1/7/2007 to 31/3/2008. What is the annual return? It's given in the question. 153.33. The annualized return is 153.33. Period of investment in months. Okay, I just need it in months. Period of investment. Days can also be done. It can be done, but they have done months only here. How many months is the investment? Period of investment is 9 months. Holding period return percentage. HPR into 12 by M is annual. Annual into M by 12 is holding period. Holding period return, when you multiply with 12 by M, you get annual return. From annual return, if you multiply with M divided by 12, you will get the holding period return. So what is the holding period return? 100 and 115. 153.33 into, it's technically like this, 153.33 is equal to 12 months, 9 months equal to question mark. 153.33 is for 12 months, 9 months is question mark. Any doubts on this? Closing value, some dividends are paid, but that does not matter because it's a reinvestment. Dividend is not part of my income. Dividend is not part of my income. See, listen, closing value is equal to opening value plus HPR. Opening value plus HPR. If there is some dividend is there, then this opening value plus HPR minus dividend, because dividend is also forming part of HPR. Dividend also forms part of the holding period return. So the return are in two forms. One is your dividend and second is capital gain. Dividends are not there in this question because they are reinvested. So closing value is 1 lakh plus 115%. Any doubts on 2,15,000? Now listen, this is an important concept. Listen for some time, then you can write it. 10,000 units, 21.5 is the NAV. Okay, 10,000 units, 21.5 is the NAV. Mutual fund is declaring some dividend on the date. What is the dividend they are declaring? 10%. Is that face value given in the question anywhere? Okay, so dividend per unit is 1 rupee. NAV of the mutual fund will fall by the amount of dividend. Once the dividend is declared. This will exactly happen. Okay, fall exactly by the amount of dividend once the dividend is declared. Now, why does it fall? Is we did this calculation. In the liabilities, moment you declare dividend, a liability will arise called as dividend payable. So NAV will fall. Assume I declare and pay it immediately. Cash will come down. Either the asset will come down or liability will go up. Net asset value of the fund will go down once the dividend is declared. Your NAV will come down. Why does it come down? Because our valuation says all assets minus liability. Moment you declare dividend, a liability is created. If you have paid out the dividend, that liability is not there, but asset has come down. Indirectly, net asset of fund will come down. So this will become 20.5. Can you tell me what is this balancing figure? What into 20.5 is 2,15,000? What into 20.5 is 2,15,000? 10.8. Okay, 10,487.80. Now listen, I purchased the mutual fund. I got 10,000 units. By 31/3/2008, I had 10,000 into 21.5. They declared dividend. I did not want dividend. I reinvested. I reinvested that money. I said I don't need dividend. So what they did is they made my 10,000 as 10,487. Now NAV as on 31/3/2008 has two answers. Before dividend 21.5. After dividend 20.5. Before dividend 21.5. After dividend 20.5. Now, how did this 10,487 come? Is I'll be allotted 10,000 rupees of dividend. I'll be given 10,000 rupees, 1 unit, 1 rupee dividend. 1 unit, 1 rupee. Reinvestment will happen at this NAV. Reinvestment will happen at 20.5. Reinvestment will happen at 20.5. Why it happens at 20.5 is dividend declared, NAV fell, dividend reinvested. Dividend declared, NAV has fallen immediately. I reinvest my dividend, so I'll be allotted units at the rate of 20.5. 10,000 divided by 20.5 would have been 487.8. 487.8. So 10,000 which you invested now has become 10,487. This will further become 11,296.11 by the time you close the fund. By the time you come out of the investment, 10,000 as of now has become 10,487. So now write NAV, write this calculation, show this calculation. Now listen, why I showed this calculations. Some students end up taking reinvestment at 21.5. 10,000 divided by 21.5 is the reinvestment they end up taking sometimes. They end up taking, if you do 10,000 divided by 21.5, you will be allotted lesser units. You will be allotted lesser units. See, my value is 2 lakh 15. Whether you pay dividend, don't pay dividend, I need same 215. I need same 215. Rule says if dividend is declared, NAV will fall. I don't have a problem. Give me more units. Give me more units. I need my 2,15,000. I need my 2,15,000 because I am not paid out any money. If you are not giving me any money today, ensure that my 2,15,000 continues. So 2,15,000 is split as write 10,000 and 21.5. Write these two charts, then below that I'll give you the answer. In exam, this is not needed. These two charts and all, this is more for your understanding. $215 is split as 10,000 into 21.5 and again split as 10,487.8 and 20.5. Clear? Any doubts? Now, I'm not sure if you have left space here. If you have left space, you can write this. In exam, this alone is needed. NAV before dividend 2,15,000 divided by 10,000. The chart was just for your understanding. NAV before dividend NAV post dividend 21.5 minus 1 rupee. 21.5 minus 1 rupee. Pre dividend 21.5, post dividend 20.5. Before dividend 21.5 and after dividend 20.5. Units allotted. This number is needed to answer the next part of the question. Okay, units allotted 10,000 units into 1 rupee. 1 rupee is the dividend. 10,000 units into 1 rupee allotted at 20.5. Allotted at 20.5. 10,000 units into 1 divided by 20.5. Allotted at 20.5. You get 487.8. Any doubts on this? Clear? And the last line, closing units. 10,487.8. This is there in the chart, but chart is just more for your understanding. Chart was more for your understanding. In exam, you just need to write these. We have completed one part of the calculation. NAV as on 31/3/2008. That part is done. Any idea how do I get NAV as on 31/12/2009? How should I get NAV as on 31/12/2009? 31/3/2010 I have explained. 2009 what can be done? There is no annual yield given for 31/12/2009. They have not given the annual growth or yield. If yield was given, what you say is perfect. What should I do then? You already done this concept somewhere, so think what can be done. Yeah, reverse work from 11 to 96.11. Just give me a minute. I'm going to do this calculation now. My You can write it in sometime. 31/12/2009. What is the dividend rate they have declared? 20%. On this day, my units were 10,487.8. My units are 10,487.8. The opening units were. Dividend in rupees is this into 20% into 10 rupees. 20% into 10 rupees on face value. This will see it. Closing balance is 11,296.11. There is only two times dividend is paid. On last date, no dividend date has given. So whatever is that closing balance you see, 11,296.11, and the gap is the units allotted. The gap is the units allotted. So dividend in units is this minus this 2975.6 divided by the reinvestment NAV is the dividend in units. Divided by the reinvestment NAV is the dividend in units. We have already done this. We have already done this. Next, working note to computation of NAV as on 31/12/2009. Computation of NAV as on 31/12/2009. Do this calculation. The reinvestment NAV is the balancing figure. Reinvestment NAV is going to be the balancing figure. The reinvestment NAV is balancing figure. How much is the reinvestment NAV? How much? Computation of NAV as on 31/12/2009. This is the calculation. Any doubts on this? Clear? Can you proceed? Any doubts? Okay. Exam answer just at 25.95 only. They did not give two answers, but I'll write both. NAV before dividend, NAV after dividend. Before dividend and after dividend, write the numbers. NAV before dividend and after dividend. How much is the NAV before and after? Before and after dividend. How much is the NAV before dividend? Guys, please participate. Right, wrong, and all doesn't really matter to me. What is the NAV before dividend? I'm not able to hear anything. So you'll have to be louder. You are in the first, second row. So please be louder and let me know. Right, wrong doesn't matter to me. What is the NAV before dividend? 20. I'm hearing 20. After that, I'm not hearing anything. So 20, is it 27.95, 25.95, 23.95? What is the answer you want to give? First, this 25.95, is it before or after dividend? This is after dividend. Before dividend will be extra 2 rupees. Before dividend is going to be extra 2 rupees. Once dividend is paid, NAV will fall. Once dividend is paid, NAV will fall from that date. So what happened in the earlier question is you calculated 21.5, subtracted 1 rupee, got 20.5. Here you have got 25.95, you are taking it back to 27.95. 25.95 is the reinvestment NAV, which is the closing NAV or post dividend, which is the post dividend NAV. So pre-dividend is post-dividend plus dividend. Normally what you do is NAV before dividend, subtract the dividend amount and get the post-dividend NAV. Any doubts on this? Any doubts on this part? Clear? Can you proceed? Next part is on 31/3/2010, he redeemed all his units when his annualized yield was 73.52. Now listen, this annualized yield of 73.52 will be from the date of my investment. Will be from the date of my investment. If it is for a specific year, then they'll have to say annual yield from this period to this period is 73.52. Normally, for example, we calculated this annual rate of return as 67.64 in one of the problem. This 67.64 is from the date of investment for the 124 months. From the date we made the investment till 124 months. In the last class we did some problem on growth plan versus payout plan. So wherever we did that, whatever return you calculated is from the date of investment, is from the date of investment. So I'll give you some 3 minutes. Repeat this calculation again. Listen for a minute. Amount of investment, annual return from 1/7/2007 to 31/3/2010. To 31/3/2010. Number of months, holding period return, closing value is 1 lakh plus that value. 1 lakh plus that value. NAV no before dividend, no post dividend. One NAV only. There's no dividend here. NAV is closing value divided by the number of units. Closing value divided by number of units. Do this calculation. The annual return is from the starting date till 31/3/2010. 1 lakh is the investment, 73 percentage is my return annualized. Period of investment is 33 months. So into 33 by 12 is 202%. Into 33 by 12 is 202%. 1 lakh plus 202 is 3 lakh 2180. Divide by 11 296.11 will give you the closing NAV, which is 26.75. The closing NAV is 26.75. Any doubts on this? Let me know if there are doubts. So all the three NAVs have been computed in this. Can we proceed? Any doubts? Done? Now, a similar question came, I think, in one exam where instead of giving the annual return, they directly give the holding period return. They directly give the holding period return, becomes more easier also. You directly apply the HPR and then get to the answer. They can say for some returns they can give HPR, some they can give annualized. Their wish. What can be applied on the investment is holding period return. What can be multiplied is only the holding period return. 20 will be homework, but I'm going to do a similar question which came in exam with one extra adjustment. So go through this. It's a similar question, exact wordings and all, with one extra adjustment. This is an extra material, but in the normal material you will see a similar question. A similar question is there. Changes in numbers and one or two extra adjustments. This came in the recent exam. Okay, let's understand this. A mutual fund made an issue of 10 lakh units of 10 each on Jan 1 2021. No entry load was charged. Made the following investment: 25,000 shares of 320, 5% common security, 10% debenture, 8% debenture. During the year, dividend of 8 lakh was received. Interest on all types of debt securities were received. On 31st December, equity shares appreciated by 15%, while listed debentures were quoted 20% premium. XYZ Limited on 15th December declared an interim dividend of 10%, bonus shares at 1 is to 10 with a record date of 28th December 2021. Find out the NAV as on 31st December, given that the OPEX paid during the year is 3 lakh. Find out the NAV if the MF had distributed some dividend and annual rate of return. Now, when I have to calculate NAV, I've said all assets minus liability. All assets minus liability. What are the assets I'm going to have is equity shares, government security, debentures, listed, unlisted. All these assets are there. Some liabilities, if there, I subtract them and I get to the. Now, there will be two types of question. One type of a problem where you can track all cash inflow and outflow. Track all cash inflow and outflow of the mutual fund. Track all cash inflow and, for example, this is day one inflow. This is day one outflow. This is inflow. This is inflow. Interest on all type of securities were received. On 31st December, equity shares appreciated something, and this is outflow. OPEX paid is 3 lakh. If you are able to track all inflow and outflow, you will have to calculate closing bank balance by preparing a cash budget. By preparing a cash book or a cash budget, you will have to calculate what is the closing bank balance. What is the closing bank balance? some problem it will not be possible to track all inflow and outflow, because they'll say he bought something, he sold something, or they'll not give the values and all, but he'll say purchase and sale kept on happening, purchase and sale kept on happening. If I'm not able to track the inflow and outflow, then I cannot write the closing cash balance. Sometimes they can give the closing cash balance directly itself, they can give you the closing cash balance directly. So first working note will be computation of cash balance as on December 31 2021. Computation of cash balance as on December 31 2021, will calculate that cash balance. Then I'll value various assets. In my asset, one of the asset will also be dividend receivable. Dividend receivable. There was an interim dividend paid on 15th December. Sorry, declared on 15th December. Record date is 28th December. 28th December. I'm not very sure on your Companies Act rules. The rule says after the record date, the dividend has to be paid. Now, it can have, I think, some 21 days of time period could be allowed. I'm not very sure on the time period part, okay? But I'm not sure whether by 31st December I got this money or not. If I have got this money, cash would have gone up. Cash would have gone up. If I have not got this money, there will be an asset called as dividends receivable. There will be an asset called as dividends receivable. I will not account only after receipt and all, because I'll have to consider the fair value. The NAV has to consider what is the value of the asset. So let's first calculate the cash balance. Working note 1. Computation of cash balance as on 31/12/2021. Cash balance as on 31/12/2021. Particulars and amount. We will have to track the various inflows and outflows. There will be a question where this tracking will not be possible. You will learn as we proceed. Inflow from unit holders. This happens on the first day. Inflow from unit holders. How much money do I receive from the unit holders on the first day? How much? Okay, 10 lakh into 10. 1 crore money I've got it from the unit holders. Less investment made. On that day I made investments. Give me a total of all that. All investments put together, how much did you invest? 90? Okay. So I'll be left with 1 lakh as of now. 99 lakh is the investment made. Read question, tell me if any inflow comes, dividends, interest received, interest paid, anything, any inflow, outflow, please tell me. What is the next inflow or outflow? Add dividend received, 8 lakhs. Dividend received is 8 lakhs. Add interest on, there are two securities, interest on, sorry, three securities. Interest on 5% government security. See, if I have received, fine. If I don't receive, this will become accrued interest and will come in the asset side. It will come in the asset side. Interest on 5% government security, 4 lakh into 5%, 20,000. Interest on 10% debentures, 10% debentures, 50,000. Interest on 8% debentures, 80,000. 10% debentures, 8% debentures, and 5% government security. The question can also add on, it can also add on data called as, sorry, the question can also add information on purchase and sale of shares. They will say you purchase shares of so much, sold shares of so much. If they give that data, you consider that. Less expenses paid. How much expense paid? Apart from that, that interim dividend may get in, but I'm assuming that it's yet to be received, so I'll show it as dividends receivable. I'll show this as dividends receivable. Closing cash. There's a rework to this. We'll see rework later on. Rework some dividend payout and all, something is mentioned. Closing cash 7 lakh 50. Closing cash is 7 lakh 50. Closing cash is 7 lakh 50. Any doubts on this? Working note to computation of NAV. In the asset side, one of the asset is going to be cash. Computation of NAV. Particulars calculation amount. Value of assets. Particulars calculation amount. Value of assets. Now tell me what are the assets the MF has on the last day. Whatever investments I made will be my assets, okay? Whatever investments I made, because they've not told about any buying and selling. Equity shares. Tell me what into what. What should I multiply? Shares into the price. Tell me what into what. 25,000 into 3. 320 is the open today's value. Read the question and tell me. 360. Guys, please be a little louder. It's okay. 25,000 into 368. Wrong. It's 27,500 because there is a bonus issue which is made. There is a bonus issue which has been made at the rate of 1:10. 1:10. Again, I am not very sure on the law part, but I assume that bonus shares would have got allotted to me on the record date. That's my assumption. Bonus shares would have got allotted on the record date. On the record date, I may check this part and let you know if at all anything is there on the legal side. That is something you learn in your securities law. So if something SEBI rule says, that has to be followed. My assumption is bonus shares would have got allotted to me, and my closing price is 320 plus 15%, which is 368. 320 plus 15%. 27,500 into 368. 27,500 into 368. Did you guys check on cost of acquisition of bonus units? Anybody read about that? What did cost of, I told you to check, no, on the tax side. It's 0 only. Bonus units is cost of acquisition 0 only. Okay, then fine. Equity shares 27,500 into 368. 5% government security. Anything mentioned in that para about 5% government security? If nothing is mentioned, same value, 4 lakh rupees. If something is mentioned, please consider that, else write same value. 5% government security, 4 lakh. Next is 10% debenture. Anything mentioned about 10% debenture? No, same value then. If nothing is mentioned, same value. 10% debentures. 8% debentures, anything mentioned? 20%? Okay, premium, so plus 20%. 10 lakh plus 20%. See, they can complicate things saying that debentures is paying an interest of 10%. People are expecting 5%. Life is 5 years and the value is at fair value. Then you'll have to do present value of future cash flows discounted at investors' required rate of return. Year cash flow, PVF, TCF, value the bond, and then come to this. Share part, they can say the share is likely to pay a dividend of 15 rupees. It will grow at the rate of 10%. Value the share as per Gordon's model, and the fair value is today is of that. So they can try to do anything in the question. They can make those points in the problem. Apart from this, there is a cash balance. How much is the cash balance? 7 lakh. In this cash balance, we have already subtracted the expenses, 7 lakh 50. Dividend receivable. Dividend receivable. Now it can be two things, okay? Dividend could have been received also. It could have been, they record it, after that they could have received this dividend. If they have received this dividend, cash balance will go up. If they have received the dividend, cash balance will go up. If they have not received the dividend, it will be accrued dividend. Now, the dividend was declared on 15th December. It was declared on 15th December. On that day, I was holding only 25,000 shares. On that day, I was holding only 25,000 shares. The number of shares increased to 27,500 after that bonus. So dividends will be paid only for those units, which existed before the bonus issue. We had done one problem like this in the security valuation where they said bonus issues in the ratio of 1:2, and I said that for that year when the bonus was declared, we will not consider dividend extra. From next year onwards, we will consider extra dividend. We'll end up considering extra dividend. So my dividend receivable is 25,000 shares. 25,000 shares into 10% of face value. Into 10% of face value into 10 rupees. Into 10% of face value. 25,000 shares into 10 rupees. I hope this is the assumption they have taken. If they have taken something else, we'll see. At least I don't see an issue with 25,000 into 10. The only thing is it can get added to cash or it can show as dividend receivable. That is one possibility which can be there. It can get added to cash. Any doubts on this? Total assets slash net assets. There's no liability, so I'm not writing less liability. There is no liability in the question. Total assets slash net assets. Yep. 25,000 into 100 into 10%. Face value is 100. Of 100 each. So 25,000 into 100 rupees into 10%. Divide by the number of units. Number of units, NAV per unit. Nothing is mentioned about the increase or decrease in units, so this is the NAV. I did not write less liability, doesn't really matter. Less liability part doesn't really matter. Any doubts on this? Clear? Assumption is no change in the units during the year. No change in units during the year. Any doubts on this? This is part 1 of the question. NAV if dividend is paid. NAV if dividend is paid. They have paid a dividend of how much? 0.5. NAV will fall by this. NAV will fall by the amount of dividend. NAV will fall by the amount of dividend. NAV is going to fall by the amount of dividend. 13.22 will come down to 12.72. Will come down to 12.72. Reason for this is cash balance would have come down by 5 lakh rupees. If you have distributed dividend, 7 lakh 50 will come down to 2 lakh 50. 7 lakh 50 will come down. If this becomes 2 lakh 50, NAV automatically becomes 12.72. NAV becomes 12.72. Any doubts on this? If you are the investor, what is the annualized return you have got? You do this and let me know. I'm not going to even explain this. Ideally, you should be in a position to do this. No explanation to this. You calculate the return and tell me. I'm not going to even explain this part. We have touched upon this multiple times, so you should be in a position to do. Tell me what is the annual return? How much? 32.2%. Your wish, how you want to do. NAV 1 13.22 minus NAV 0 10 rupees. No dividend. No dividend. Or 12.72 minus 10 rupees plus 0.5. If dividend is there, add 0.5. NAV will be lesser. NAV will be lesser. Divided by 10 into 12 by 12. It's a 1 year calculation into 100. Into 100. So technically it's 32.2%. 32.2%. Okay, the solution has assumed that interim dividend is also received. We have taken dividend receivable. In the solution, interim dividend is also received. Interim dividend is also received. So my NAV remains same, 13.22 and 12.72. That does not undergo any change. 13.22 and 12.72 remain as it is. The only thing is the assumption or the solution assumes dividend has been received by the unit holders. Any doubts on this? Any doubts on this part? You can do 20 as homework. You're not going to get anything out of this question, more for practice. But it's exactly the same thing. ICA just added 2 more adjustments in the exam question. They added 2 more adjustments. The same thing they did with 19 also. In 18 also they added 2 adjustments and made a exam question. Here also they added few adjustments and made it as an exam question. Go through 21. Go through the question. Okay. We are required to calculate the NAV of a regular income scheme of a mutual fund. They have given various values. Listed equity shares, so much is the value, cash is so much, bonds and debentures, bonds not listed, not quoted. So everything has been given in the question. Cash is mentioned in the question, so no need to try to calculate the cash. One exam question, what they did is cash in hand as on 1/4/2015. They gave the opening cash. They gave the opening cash. From opening, you have to go to the closing cash. From opening, you have to go to the closing cash. What will be done? I'll explain later. What would have been done? For example, in this question, it's impossible to track inflow and outflow because one, if they give me opening cash, bonds and debentures are there. I don't know their interest rate. I don't know their interest rate, so I don't know how much do I. They have not given any data on any dividend received. Nothing has been mentioned in the question. So if they had given the opening cash, and if this comes as an exam problem, they just said opening cash minus expenses paid is closing cash. Opening cash minus expenses paid is closing cash. This is a doubt many students keep asking me, that when I'm going to do the solution, in the solution, this line is of no use, because I already have the closing cash and expenses is already paid. Expenses paid is neither an asset nor a liability. Expenses already paid is neither asset nor liability. So it's not going to come in my calculation. It's not going to come in my calculation because closing cash is given. Closing cash is given. The question was, I think, cash in hand 5 lakh is what was given in the question. They changed this question because they maybe ICI felt that it's not very logical to just consider one item and calculate the closing cash. So they had given the opening cash, deduct expenses paid, closing cash. Opening cash, deduct expenses paid, closing cash, which is not a very logical way, which is not a very logical way to complete the solution. So here what you need to do is you need to value listed equity share. How you value? Some data is there. Then you have to write cash in hand. Bonds and debentures, listed is there, unlisted is there. If some extra information is there, value it. If no extra information is there, write the same amount. Write the same amount. Other fixed interest security, dividends accrued, amount payable, expenditure accrued, everything will go in the asset or the liability side. Let's write computation of NAV. Computation of NAV. First is assets. Particulars calculation amount. We'll do it in lakhs. Value of assets. We'll go item by item. Listed equity shares. Listed equity shares. The cost is 40 lakh. Okay. When you purchased, it was 40 lakh. Below they are saying all the listed equity shares were purchased when market portfolio index, technically Nifty, when Nifty was 12,500. Today the Nifty is 19,975. The best way of valuing my portfolio is getting to know what are the shares in my portfolio and what are their prices. Proxy for that is, if market has gone up by 10%, my portfolio will also go up by 10%. That's a proxy valuation. So what we are going to do is 12,500 is equal to 40 lakhs. 19,975 is equal to question mark, today's value. 12,500 is equal to 40 lakh. When you purchase, it was 12,500. Today it is 19,975. Value would have gone up. Value would have gone up. So do cross multiplication. 40 into 19,975 divided by 12,500 into 19,975 divided by 12,500. 40 has gone up to 63.92. 40 has increased to 63.92. Any doubts on this? Listed equity share 63.92. Cash in hand directly, right? No adjustment. If it was opening cash, then we had to do something. This is closing cash. Cash in hand 2.76. I'll break up the bonds into two, listed and unlisted. Okay, listed and unlisted. First is unlisted bonds and second is listed bonds. I'll break this up into unlisted and listed. Cost of unlisted bond is 2.5 lakhs. Of this bonds not listed, not quoted is 2.5. Balance is listed. Any extra information for unlisted bonds? 15%. Okay, so unlisted 2.5 lakh minus 15%. 2.5 lakh minus 15%. 2.5 minus 15. 2.125. 2.5 minus 15%. 2.125 lakhs. 15% reduction is there. Listed will be 8.96 minus 2.5 if no info. Okay, if no info in the question, 8.96 minus 2.5. Any information on listed bonds? Value of how much? 7.5. They carry a value of 7.5. Listed bonds is 7.5. Next is other fixed interest security. If nothing is given, follow that number. If something is mentioned, let me know what is they are mentioning. Anything mentioned about other fixed interest security? Face value is 100 and today's realizable value is 96.5. So 9.75 lakhs is equal to 100. Question mark is equal to 96.5. 9.4088. I'll work with 4 decimals. 9.4088. 9.75 lakhs into 96.5 by 100 into 96.5 by 100. Any doubts on this? Clear? What's the next item? Dividend accrued. Now, not sure whether this is accrued dividend income for me or basically is it a liability or an asset. It could be that you have to pay this dividend, then it's a liability. It could be that you have to receive this on listed equity share. I normally take it as assets. We normally take it as asset. Dividend accrued. Dividend accrued 1.95. Expenditure accrued is liability. Amount payable on shares is also liability. What is amount payable on shares? Is whatever purchases we have done that is yet to be settled. That is yet to be settled. Any other asset in the question, in the additional information, any other asset, any accrued income, anything mentioned in the question, any other asset? No. Total assets. Total assets. Less liabilities. We'll subtract the liabilities. Two liabilities are there in the table. Apart from that, anything extra can also be there. Amount payable on shares. $13.54. Expenditure paid is of no use. Paid part is of no use. Expenditure accrued. How much expenditure accrued? 1 point. Total liabilities. Total liabilities 15.3. Total liabilities is 15.3. Net assets, number of units, NAV per unit. Net assets, number of units and NAV per unit. Net assets, number of units and NAV per unit. Net assets is some 72 lakh rupees. 72 lakh. How many units are there? 2 point and NAV is some 26.3141. The NAV is 26.3141. We have taken various assets given in the question, valued them and got to the answer. Any doubts on this? Clear? Can you proceed? Any doubts on this? '22, I'll give a video. This is not something which happens in the practical world. but they ended up asking two times in exam, so I don't want to miss out. But I'll give a video for this to you. Go through 23. Go through question 23. Okay, let's look at this question. On 1/4/2012, ABC Mutual Fund issued 20 lakh units at 10 per unit. Relevant initial expenses 12 lakh. Invested the fund in capital market instrument in a portfolio of 185. During the month, it disposed some of the instruments costing 60 lakh for 63. Used the proceeds in purchasing security. Fund management expenses is there. In April 2012, it earned dividends amounting to distributed 80% of realized on 34/2012 market value of the portfolio. If you read from line to line, every line is talking about some inflow or outflow. Every line is talking about some inflow or outflow. So first thing is we'll calculate the closing cash balance. We'll calculate the closing cash balance. Once we do the closing cash balance, then we will calculate the NAV. After the NAV is done, you can calculate the annual rate of earning, because annual rate of earning is NAV 1 minus NAV 0 divided by NAV 0 plus D1 plus CG1. You will have to add that into 12 by M into 100. So working note 1, computation of closing cash. Computation of closing cash. Particulars calculation amount. Computation of closing cash again in lakhs. This is the most important part. Once this is done, balance is formality. Computation of closing cash. Read that and tell me each transaction. What is the first transaction which is going to happen? Every line has a transaction. Yeah, guys, please. Inflow from unit holders. Inflow from unit holders. How much into how much? 20 lakh into 10, 200 lakhs. We are doing it in lakhs. Inflow from unit holders 200. What's the next thing happening? Less initial expenses. If it is paid, cash will come down. If it's not paid, it will show us a liability. So here it's paid, less initial expenses. How much is initial expense? 12. Less initial expense 12. What's the next thing done? Purchase of shares. What is the value of shares purchased? 185 lakhs. Purchase of shares 185. What's the next transaction done? It disposed of some of the instrument costing 60 lakh for 63. 3 lakh is the profit. We don't calculate profit or don't write profit and all. What will come automatically is add sale of shares 63 lakh. Sale of shares 63. Sale of shares 63. There is a use of that 3 lakh. You will learn that in some time. The 3 lakh will be used for some purpose. Sale of shares 63. What did he do next? Less purchase of share 56. Purchase of share 56. What's the next transaction happen? Less fund management expense. Whatever has been paid, tell me. Unpaid will go as liability. 7.2. 80,000 will go in the liabilities and assets part. Fund management 7.2. Fund management is 7.2. What else is there? Add dividend received 2 lakh. Dividend received 2 lakh. And distributed 8. Distributed means dividend paid. Distributed is dividend paid, less dividend paid. Less dividend paid. How much is the dividend paid? 80% realized earnings. So 80% of 2 lakh, how much? 1 lakh. What is the dividend paid? Is it 80% of 2 lakh? Then, now listen, there are three things which a mutual fund will get. One is called capital appreciation, which is unrealized. Capital appreciation, which is unrealized. What is unrealized is you bought the share, you are yet to sell. Second is realized capital gain. Realized capital will form part of realized gain. Dividend will also form part of realized gains. Dividend will also form part of realized gain. The data saying 60 was sold for 63 to calculate the realized gain. So my dividend is 80% of 3 plus 2. 3 lakh is the realized profit. 2 lakh is the dividend. 2 lakh is the dividend. 80% of realized gain, which is realized profit of 3 lakh plus dividend of 2 lakh. Closing cash. Some 80,000 is the closing cash. Dividend paid is 80% of realized earning. What is realized earning is capital gain realized plus the dividends. Now listen, I have been saying this D1, CG1 at multiple places. So if I want to say 80% of 3 lakh is CG1, 80% of 3 lakh is CG1 because that is paid out of the capital gain. That is paid out of the capital gain, and 80% of 2 lakh is D1. It doesn't really matter from my calculation point of view. D1, CG1 is same for us. It is technically same. Any doubts on this? Working note to calculate NAV. Assets minus liabilities. See what assets is there. Cash is one of the asset. Cash is one of the asset. Some liabilities can be there. Calculate NAV. 2-3 minutes for you to do. Asset side, cash is one. Apart from that, I think the value of investments is there. And liability side, fund management expenses payable. Fund management expenses payable. Let me know the closing NAV. How much? 9.9. Your value of portfolio is 198 lakh. I'm not showing it here. Value of portfolio is 198. Cash is 0.8. Total asset 198.8. Liability 80,000, 0.8. Net assets 198. Net assets is 198. Number of units is 20 lakh. NAV per unit is 9.9. Once this 9.9 is calculated, then this guy may move out 100 units. That and all doesn't matter, because when people move out or come in, NAV does not change. NAV is going to be 9.9. Whether this guy moves, he says he disposed of the same at the closing NAV, doesn't really matter to us. It doesn't really matter to us. He has disposed of the same. It's not going to matter in our computation. Any doubts till now? Clear? Can we proceed? Any doubts on this? Okay, now calculate annual rate of earning. One unit itself is fine. NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 12 by M into 100. ICI, this question has done months calculation. The date of investment is available. They have not done days calculation. They have done months calculation. So in exam situation, if possible, please do both wherever date of investment is available. For example, I can do into 365 by 30, 30 days of investment, 1/4/2012 to 34/2012, or I can do into 12 by 1. This question they have done months calculation. NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 12 by M into 100. What is the closing NAV you have calculated? 9.9. Opening 10. Dividend per unit, dividend and capital gain together. Okay, I'm not doing it separately and all. We paid a dividend of 4 lakh for 20 lakh units. We paid a dividend of 4 lakh for 20 lakh units. Dividend of 4 lakh is for 20 lakh units, which is 0.2. You can bifurcate as D1 CG1 if you want. It doesn't really matter. Denominator is 10 into 12 by 1 into 100. 12 by 1 into 100. This is the annual rate of earning. This is the annual rate of earning. Any doubts on this? Okay. We're kind of done for today. I'll just summarize what we have done in today's session. We started with a concept called as front end load and back end load. Front end load is also known as entry load. Back end load is also known as exit load. Front end load is nothing but whatever is your issue price plus the extra part. So offer price is equal to issue price or the face value plus the front end load, and the redemption price is equal to the fair price minus the back end load. You subtract the back end load, you add the front end load, we convert that into percentage. Then we started with NAV computation. In NAV computation, the base thing we understood is NAV is equal to value of all assets, fair value of all assets minus value of liabilities divided by number of units, first problem we did, what we saw there was they had given the opening net assets. We have found out items which can increase net assets, items like issue of new units, items like portfolio appreciation, items like dividends paid. You considered all that and find out items which can reduce your net assets, which is like expenses paid or items like your redemption, then divide by the number of units and get. The NAV per unit will not undergo a change just because a new person is coming in. We saw a problem where a person gave a check of 50 lakhs, he came into the fund. The NAV is not going to change just because the investor has come into the fund. What will indirectly happen is numerator will go up, denominator will go up, NAV per unit will remain same. NAV per unit is going to remain same. NAV will undergo change, only the underlying assets undergo a change. Underlying assets, that is the value of the share, undergoes a change. Then we saw concept linking holding period return and annualized return. Holding period return is nothing but instead of without doing into 12 by M, an annual return is equal to holding period return into 12 by M. If you do into 12 by M, if I know the opening value and I want to know the closing value, opening value plus the HPR is the closing value. Opening value plus the HPR is the closing value. NAV per unit will fall by the amount of dividend. Once the dividend is declared. I have calculated the returns for the 3-4 funds which they wanted me to analyze. If I am planning to hold on to only one fund for future, I'll hold on to the fund which has the highest return, If there is an exit load also, then see for the proportionate period which is left over, how much loss are you going to have? If the loss is more than the exit load, bear the exit load and move out. If the loss is lesser, then continue with that fund and don't bear the exit load. There's no point in bearing the exit load. Other thing is, if there is some interim dividend paid, the interim dividend will only be for the base units and not for the bonus units. And when you do the closing value of the shares, you will include the base shares plus the bonus shares. Bonus shares would have got allotted. You will consider that also into consideration and then do the calculation. There will be problems where cash computation is possible. So you'll have to track all inflows and outflows and compute the closing cash. Once the closing cash is computed, you value the various assets and liabilities and calculate the NAV per unit. A question may say that dividends paid out is so much of realized earning. That realized earning is basically capital gain realized by us plus the dividends. Clear? Any doubts on this? With this, I'll end today's session.